YouTube. Greetings, everybody. We'll be with you in one moment. And I'm hitting record right now. And we're going to go ahead and let our audience in, which is an audience of one so far. Emily, welcome to the meeting. Waiting for signal. All right. Good morning, everyone, in Running into the Fog land today. My name is Eric Johnson, and I'm here with my brother Derek, co-host of the podcast Running into the Fog, and we've got our good buddy Jason Voyevich on here with us today. Hey, Jason.
Hey, how you guys doing?
Living the dream, as they say. And I think, unfortunately, the Facebook stream may have pooped out on us, but we'll see if it picks it up again. I thought I fixed that.
Derek, how are you? Not to swear, Eric. You're really clear about that. I know you use the word poop. I understand, but you know there was a day back. It was part of the broadcast standards back when those jean jackets were popular. Way back when, where that was one of those things you couldn't say on TV. So I'm just pointing that out, that we should be careful about the instructions you give me, because I will find new and creative ways to introduce profanity.
Well, that is why you are my favorite CMO, Jason, is because you are so adept at that. And I'm going to spotlight us here. Welcome, audience, as we're coming online. We're getting going here. I want to say a special shout out to my baby brother, my jean jacket wearing twin here for Running into the Fog. It's his 19th anniversary at Aurora, and he's going to be starting his 20th year in the competitive intelligence profession here with us today. And so, Derek, any words or thoughts, reflections on your last 19 years?
It went by fast. That's about all I have to say about it. You know, I think back to how I didn't know anything about anything 19 years ago. And, you know, I still don't know that I know all that much, but maybe a little bit more than I did back on the 1st of March, 2003. And just happy to be here. Consider it a real privilege to work with you and Jason and others here at Aurora, and just look forward to a couple more decades anyway.
Well, there's nobody else I'd rather have as my business partner than you. I think Mom and Dad would approve.
Yeah, we were having a little sidebar this morning about that, and our parents were a very unique combination. And I think we probably, between the two of us, we have both of them fully encapsulated, living on their memories, right? So yeah, I think they'd be good and proud of us.
Amen. So Jason, you and Derek have been working on something the last few months, and I am eager to see what that's about, hear more about it. I'm going to just leave it at that, and you guys decide how you want to talk about it, because I don't even want to put words in your mouth here. So take it away. And by the way, first half of this stream is called Unthinkable. Those of you who are here in attendance on the live stream, on social, fantastic. We're glad you're here, but join us on the bridge, the Zoom bridge, which is corv.vc/RITF 2022. I will actually post that in the chat on social here as well, just so everybody's got it. But sign up for that, and you'll then be part of that kind of insiders group, because at the half hour, we're going to go to unspeakable territory, and then Jason can really start cussing at you. So, guys, what have you been working on?
You want to set it up, Jason, or you want me to?
No, go ahead. I'll layer in.
So, you know, it might be related to what I did before I joined you, Eric, for the first few years of my professional career. So, to our listeners, I worked for an investment firm, was fully committed, really vested into this path of becoming a portfolio manager, and you know, loved everything about it. And then something changed in 1999, or at least that was the inflection point that started to change what would become, you know, this 19th anniversary I celebrate today, and that is our dad died. So February 1st of 99, dear old dad passes away. Talk about running into the fog, right? 24, you were about 28. A short 2.5 years or so later, our mom passed away. So by 2001, I was fully orphaned and open for work, if you will. And while I was still totally vested into that portfolio management game, the opportunity to emerged where, you and I started talking about working together, kind of never looked back from there. Finally consummated that exchange on the 1st of March of 03, but I sort of never stopped thinking about, and I still don't, about the application of portfolio management theory to all sorts of different things. In fact, those closest to me know that I really relish every opportunity to diminish the term chief executive officer, my role here at the firm, and I think of myself more as a portfolio manager of people, portfolio manager of products, portfolio managers of the services that layer on top of the intelligence applications that we do. And that sort of led us recently, right, Jason, to ideating and imagining what it might look like to come up with a course or a series of modules that takes a really hard look at how you can apply intelligence, both qualitative and quantitative, in a very portfolio management, portfolio driven sort of way. So that's a little bit of the setup, but Jason, I know you'll add a lot to kind of what led us here.
Yeah, I think that when I think about portfolio management, I look at it in a different way. My background is in product innovation, product development. I've spent essentially my entire career doing that. Been involved in the launches of hundreds of products, hardware, software, services, you name it. And what's been interesting about Derek, when you say portfolio management, the first thing I think about isn't financial portfolio management, it's product portfolio management, which is kind of a different, seemingly completely different concept. And that's all about how do you optimize a mix of product portfolios for maximum return with a given customer base or bases. And that's really tied to the field more generally of product management, which can incorporate product innovation, product management, and product marketing. Those terms can be used often interchangeably. But the bottom line is when you and I started talking about this, the key insight I think we had was that product innovation and managing a portfolio of products is just one of the portfolios that leaders must manage. And you highlighted that really well, Derek, with kind of your role in managing people and offerings and a number of different things. And when we think about product innovation, we have to understand that you manage a number of different portfolios. You manage a product portfolio for sure. We use the example of Ford, for instance, managing a portfolio of trucks, SUVs, electric vehicles, fleet vehicles, all manner of different work trucks, you name it. But that's not the only portfolio you manage. You manage a portfolio of suppliers as Ford. You manage a portfolio of manufacturing facilities around the world. You manage internal and external stakeholders. You also manage kind of the financial side and kind of the R&D side. We could go on, but I think you get the idea that there are a number of different portfolios you manage that you need to balance. And both kind of human intelligence alone and data alone really aren't sufficient. You need a different mindset. And what portfolio theory is good at is it underpins all of those portfolios. It addresses that it's a mindset, really, more than it is. People get hung up on portfolio theory as a quantitative financial tool, and it is that, but really it's a mindset. It's a mindset that links risk and return, and it works to quantify it works to quantify risk and return in a way that you can use statistical tools to help you optimize maximum risk for or maximum return for the lowest possible risk or the risk that you are willing to tolerate. And the insight that I'm most proud of in what we're working on is being able to apply that mindset to any of the different portfolios, whether they're explicitly financial portfolios or whether they're product portfolios, whether they're portfolios of people. It forces a mindset not of treating people like numbers. That's not it. What you're really doing is you're trying to get a sense for how do you create a balance appropriately between all those things. That's what's exciting to us, is being able to apply that mindset. And yes, there are financial aspects there. We use kind of the statistical tools to help us, but the statistical tools are not the conclusion. They are an input and a way to explore a rigorous set of mindset and kind of skill set processes that help elicit better questions, lead you to explore different areas in human intelligence and other data gathering that you might not have explored before. So that's probably a longer answer than most people needed for exactly what we're at, but I'm excited to be able to combine. And I'm not sure that's one of those prime examples of horizontal thinking, right? Like, how do you apply something from another field, to a different challenge? There are risks in that, but really fruitful areas for exploration. So let me pause for a second. Eric, when you hear about that, I'm kind of curious what you took from kind of both of those little soliloquies and what jumps out at you.
So interesting that you asked me that question, because I've been looking at this area for quite a while, really since Derek joined the company. And Derek, you'll remember that we had a project way back in the mid 2000s trying to sort of take a swing at this and see if we could discover an efficient frontier, calculus for what intelligence assets should look like in an intelligence portfolio, and how that should work for our clients, and really use that as the cornerstone of a consulting offer. I still think we can do that, by the way. I think it took some time to kind of let the market mature in order to understand really that was something actionable that they could worry about. But to your question, Jason, I think that you guys are at a point where understanding and navigating the future is now well understood to be a process of coming to terms with your risk appetite and your risk tolerance, which are two different things. I have a very high tolerance for risk personally. I don't get freaked out when things go wrong. In fact, I expect things to go wrong, and I expect that to be a learning experience. But do I want things to go wrong? Do I seek out things blowing up like our Facebook Live feed just did a few minutes ago? No, I don't like when things happen that are surprising. Surprises suck in terms of my appetites, but in terms of my tolerance, it's very high. So I think what you've encapsulated there is that you've got the working elements of a theory to begin addressing product marketing, management, and innovation as the management of a portfolio of assets. And I think that's really definition of those assets and how those assets are largely intangible. They're mostly even imaginary in a lot of ways. That really gets me excited, because it's how I look at the world in terms of angles of attack. Angles of attack are exactly that. There's either the incumbent angles of attack that are subject to disruption by simplified versions of that offer that do the same thing. There's the strictly imaginary, shoot the moon deltas out there that no one's ever conceived of before, at least conceived of as something that was possible. It's unbelievable. In other words, it's not just unthinkable and unspeakable, it's unbelievable. And then there's the gammas, which is where all real new market territory is derived. All real new market territory is based on introducing something that kind of sucks, and everybody who sees it, everyone who experiences it, everyone who was first in this pandemic 2 years ago and having to go to work on Zoom, for example, it kind of sucked. And now that we're 2 years in, I know that every 20 minutes or so, I got to get up and get some circulation going, or I can't sit in a meeting like this for an hour without doing that. So in other words, we discover ways of improving the offer and its primary parameter of performance, whatever that offer is, to the point where it can all of a sudden experience really logarithmic improvement in performance while we then work on the experience of the offer and the configuration of that offer's delivery. And those are really, the way in which you program innovation, as Jason well knows, and Derek, you do too by now. You program innovation in exactly the same way you'd program a piece of software. You pull objects together, and those objects have complementarity. Sometimes they accelerate or decelerate the progress of an adjacent object, but together they're unique. They're very, very low probability that someone else is going to come up with exactly that configuration, exactly that experience in order to deliver that primary parameter of performance that you then make very predictable. And I think that's really what your work represents to me, guys, is you take a lot of the uncertainty, and I'll even be specific and say you're taking a lot of the uncertainty out of resource allocation. And man, that's the name of the game in the intelligence world. The one question that matters is, where do we invest? And if you're investing without having a risk tolerance and appetite, which is plotted against your efficient frontier, both culturally as an organization and strategically as a business unit, you're probably flying blind.
Yeah, I think about the principles of investing in my life before 19 years ago got started. And it kind of is still relevant today. There's essentially 4 components to portfolio management theory. You have to decide if you're going to participate in active versus passive management. You're going to need to make asset allocation decisions. You're going to need to be diversified to the extent that it aligns with your mindset for risk versus return. And at some point, you're going to need to rebalance, because in a perfect world, especially some of those alternative asset classes that may have higher return profiles, they're going to overshoot the other component parts of your portfolio, and you're going to probably want to get back to your neutral asset allocation parameters, right? And doing it in a way that's for corporations is a little bit different than if you're an individual investor in the market. You have tax consequences, you have inabilities to shed product lines quickly in the same way as you might a very liquid market environment, right, Jason? And those 4 categories have been fun to apply against these case studies that we've taken a look at. And I think what's cool is Jason and I have this kind of running joke. We've been working at this for 6 or so weeks, give or take. Every time we get just to the point where we think we're like, the light bulb's going off, then we try to apply this concept, quantitative and qualitative intelligence gathering, to another real world example, the Mayo Clinic or Sephora or Athleta or you name it. And we're going to continue to make ourselves feel dumber over the course of the forthcoming several weeks and months, right, as we build out those modules. But I think hopefully those around us, those that might fly in our orbit for this, they're going to be smarter at the end, and that's going to be the payoff for us. We might get smarter, hopefully, but we're going to be able to inform people on how these 4 categories, again, the active versus passive, the asset allocation decisions, rebalancing, and diversification strategies, are going to be important to the product marketing, product management, product innovation angles. Jason, what do you think about that?
Yeah, I like tying together as Eric is talking about kind of programming growth strategy, programming innovation, you can see, how do you operationalize that? There can be aspects of your portfolio and innovation that could be active versus passive. Ones where, let's just take Ford as the example to make it really real for people. How much is Ford investing in a very active strategy around electric vehicles versus, its transit vehicles? Transit vehicles are cash cows for them, but you don't see a ton of innovation happening there. It's more of a passive investment strategy. We want to keep that, delivering returns, because when you have a limited set of capital, you need to make, asset allocation decisions, and some of those are active and passive. But the biggest thing that jumped out at me, and the thing that really a lot of portfolio, what I would call kind of amateur portfolio theorists miss, is when you plot against a efficient frontier curve, which has its own challenges, and the math people, please do not text me on the difference between a normal distribution and a fat tail distribution. I understand, and I understand the limits of the efficient frontier. But what it misses often is the time component. And that's all about rebalancing, because as a gamma improves, its efficient frontier will shift. And you need to rebalance along the way as new competitors enter the portfolio and change your mix. And it's all about that whole idea of rebalancing and just that kind of quantitative look on an ongoing basis versus kind of a set it and forget it sort of strategy is really key. And I think one of the key kind of pieces of connective tissue between angles of attack and a kind of portfolio theory approach is, basically, how do you, when you're either on one of those four growth curves, what are the tools you use in order to operationalize how that translates into the organization? Is it's great if the organization understands, yep, we've got an improvable gamma. Oh, great. Do we still have an improvable gamma 9 months from now? You might not. And if now it's a beta, you have a real problem if you haven't rebalanced your innovation resources. You haven't redirected them somewhere else. And that's how often do you see in organizations that were innovative at one time and have slipped. And really, in Derek and I, in our view, they're not thinking financial management in terms of using that fourth principle of rebalancing. And I think it's that temporal aspect that gets missed all the time, which is just so important as we think through this.
Really, really good. So I just for our listeners out there, there's a graphic on the screen right now, which is sort of descriptive of this concept between risk and return and finding the efficient frontier of the right portfolio mix and the expectations that you have as an investor, really. And this is, of course, I think this is a real estate investment trust ETF, most likely. But this notion that you have a bunch of assets in a portfolio and that portfolio has time differential and how that changes over time, I think is a really, really important point. I think if I were to look at alphas and the industrial psychology behind how alphas think about risk, that's really the point. Alphas think about risk in terms of the minimum outlay of energy required in order to produce that return. Alphas are fixed income investors. In other words, they don't want to spend a lot of time doing active portfolio management because they've got this gigantic break even that they're swinging around every month called a cost structure. And so alphas necessarily are more risk averse because they have very little upside to it. They're already on top of the market. And in fact, for them, the real risk is extending their brand into domains where that brand might be diluted. If they think of brand portfolio management, and I'm sure you guys are thinking about that, if I know the two of you, that the brand portfolio itself is part of the experience promise that the offer is bringing along with it to the market. And the market has certain expectations about what it's like to ride in a Tesla, or visit a, particular type of retail store, or use a certain app from a certain app developer. That brand promise and the expectations that go along with that are often the biggest risk that the alphas find unacceptably high for them because there's so much value invested in it. And the thing they get wrong is that they assume that things are going to be this way forever, so that change over time, they want to stop change as much as possible. They want to exclude variance, right? This modern portfolio management theory is also known as mean variance analysis. They want that mean variance to be as tiny as possible, whereas the betas, they got nothing to lose. Betas come into alphas performance markets and take whatever share the alphas are willing to give them, surrender to them. Gammas change the definition of performance, and they do so with misleading superiority criteria that the incumbents in that original performance plan find puzzling. Even the betas find it unusual and puzzling. They're not sure what these guys are doing often, down that z-axis. But and most of them will fail, by the way. They're not wrong to discount most of the gammas, because most of the gammas won't work out either. Most of the gammas won't make it into stage 2 of their sinusoid. And that, I think, has been the big modification. I'd love to hear, and maybe this is where we end our unthinkable portion and we cut the live streamers loose. Go to Open Recon, everybody, register and jump on the bridge if you want to stay for the unspeakable portion of this when Jason starts cussing. But maybe that's where we sort of leave it, is that stage 2 of every S-curve is driven by adoption. And if you look at that nice adoption curve that Rogers wrote about back in the 60s, Everett Rogers was a scholar of this stuff, and in the 1960s defined the adoption curve. That first 2.5%, the innovators are the ones that, if you take an example like cryptocurrency today, cryptocurrency is at about 2.5% market penetration. What comes after innovators? Early adopters. And that's another, I don't know what it is, 12.5%, pick it up. And then you've got early majority, which is the next 33 or whatever that precise number is. But the idea that this adoption curve, you don't really start to level off the improvement of your offer until you've got 50% market share, or at least 50% penetration of your concept of the offer, no matter whether you're the sole producer of it or not. So give me a quick reaction to that in the couple of minutes before we cut our live streamers loose. And somebody can explain this mathematical formula for me on the bottom of the screen, because I flunked that day of calculus. But this notion is one that has very powerful return and yield potential for people who want to put this into practice. What's your response to that?
I will tell you, you can't see this, but what I'm holding up here is a piece of paper that I had to literally hand write out the calculation that you see there, as we tried for a first time to take a look at a 3-product portfolio analysis for Ford. And Jason and I have joked that maybe someday we'll sell this as an NFT, on some platform. I don't know that it would garner very much, but it's an example of a very humbling moment, because there was once upon a time where I could do that stuff, given some training I had, CFA and other things, without a lot of work. And I've had to re-educate myself on what, all that covariance analysis and everything that goes into these types of calculations really means. I think, the thing I take away from what you're talking about, Eric, is how many venture capitalists, essentially all of them, say, well, I have to invest in 10 to get a real yield on 1 or 2, right? They go into it and they put big money behind them, all of them, but they go into it with an expectation that they're only going to get a payout on 1 or 2 of the 10 that they might invest in. And, we've talked for years about how that's terrible odds. How can you create better certainty around which one of the 10 is going to hit? And I think that we may be onto something potentially here. Not that we're any smarter than those VC guys and gals, but by being able to apply something and understanding, most importantly, where your intelligence gaps are and fill those gaps with solid human intel work to augment the quantitative, I think is the real opportunity. I don't know, Jason, what do you think?
Yeah, I think that where I find most of my critique of VCs has always been kind of an over focus on the financial metrics, and it's because they are the ones that provide the greatest illusion of certainty. Because numbers seem more precise to people, even if they are precisely inaccurate. And I think what Derek and I are working on is applying that same mindset to non-financial assets, applying it to human resources, to an innovation portfolio. That is not without challenge. That is extremely challenging for a number of different, on a number of different dimensions, but it's worth the effort. Because if you can really, when you're innovating, people think you're innovating with kind of a financial portfolio. The funny thing, I think I'll leave it with this kind of the unthinkable piece is most people think Ev Rogers he's an engineer or he's an innovation scholar. He wasn't. Ev Rogers was a sociologist. Ev Rogers understood how people think. The whole idea about diffusion of innovations, it's the diffusion that's the important part, not the innovation part. Diffusion is all about adoption and how people react to innovations. That was the insight there, is that how does people's psychology work? And people confuse it all the time for kind of the statistics and the bell curve and all of that. And really, it's all about human psychology. And, to your point, Ev Rogers makes it very clear in the book, when most innovators have never read it, by the way, which is the number one problem. Most innovations fail. And not just like most products fail or most companies fail, most innovations fail, meaning they never make it, never make it to the bend in the S curve. And he said, basically when you look at the S curve, you always remember that what you're looking at from a mathematical perspective and a logical perspective is an exercise in survivor bias. That's really what you're seeing. Is the S curve is a survivor bias. It's kind of like the airplanes coming back with shots in the wing and not in the fuselage. That's exactly the problem. And that's why I think the key problem Derek and I are working to correct is, how do you find the bullet holes in the cockpit before it shoots a guy? And find what's making those things that never make it past the 2.5%. What are the secrets in there? How can we apply that same financial thinking to non-financial things? And what insights could they bring us when we do that?
Well, and at the lower end of the efficient frontier, the appropriate allocation of capital for that risk appetite it doesn't mean that you're going to ignore all those opportunities. It means you're going to pull the plug when they can't work, or at least they can't return the desired yield that you as an investor are allocating capital towards. So, well, this is really awesome. And I'm going to open it up to our audience here in 1 second. But first, I got to cut you live streamers free. So again, visit openrecon.com if you're watching this. Register for the Running Into the Fog Close the Distance live stream, and come back here again in 2 weeks. We're taking next Tuesday off. We're going to have a traditional podcast release, I believe, next Tuesday. And then in 2 weeks, on March 15th, we've got some special guests joining us from the competitive intelligence world. Cam Mackey, the executive director at the Strategic and Competitive Intelligence Professional Society, where Derek and I have spent a lot of time over these last 19 years together, and a little before that as well. And we're going to have 3 of our best friends from the competitive intelligence fellows on. The CI fellows have been putting together a panel. I think, Derek, you were kind of an instigator in some of that. Getting them together to give a talk at Skip. So come back here in 2 weeks. You get to meet them in person on this Running Into the Fog live stream. So live streamers, goodbye. Good luck. Don't drink too much before I see you again, and stay with us. We're going to open it up to questions from the audience here on the Unspeakable